Let me now bring on board Ajay Botke. He is head investment strategist and with Prabhudas Lilladher Securities. Ajay, good morning. Thank you for joining us. Ajay, of late it's been a one-way street for Indian markets. Nifty in quick time has cracked from levels of 5,900 to levels of sub 5,700. What is your sense? Do you think the sting is out of the system? It's time to put money to work, or in the near term Indian markets will continue to reel under pressure?
I think the correction that we have seen in the Indian markets essentially sort of has been a combination of the concerns that have again started emanating from Europe. I think we saw the imbroglio in Cyprus continuing and having its impact on emerging markets, India being no exception. So there is always a worry about how the global risk on trade pans out in the medium term. And India particularly remains vulnerable because of galloping current account deficit, which is expected to be around 6% of GDP for the quarter ending December. So I think we need to be cognizant of the fact that although yesterday's Fed statement that the ultra-loose monetary policy will continue for some time to come, and their purchases of $85 billion of treasury bonds and mortgage-backed securities will continue, I think is positive in my opinion for the global risk on trade to continue. Coming to the domestic sides, I think the fact that I think nearly 7.5 lakh crores of projects are stalled, and if you look at the number in December 2005, it was around 50,000 crores. So I think the government is cognizant of the fact that they need to speed up and the approval process for these humongously large amounts of projects, and I think they have identified 6 sectors which contribute around 80% of the 7.5 lakh crores worth of stalled projects. And all of them are basic infrastructure sectors, which are extremely essential to ensure that in the medium term, the growth rate of the economy gets going as the investment cycle sort of, picks up.
So Ajay, are you making a case that it's time to put money to work, or are you making a case that in the near term, the headwinds are too strong and Indian markets will continue to underperform global markets?
I think in the very short term, I expect a bounce back in the Indian markets, because today you are trading at around 13.2 times 1 year forward earnings of around 433 rupees in FY14. If you look at last 10 years average, we are at around 13.6 times Nifty trades at 1 year forward earnings. So there is that scope in the very short term for a bounce back in Nifty. At the same time, as I said, I think the worries on current account, the consequent pressure on rupee, BOP and macroeconomic stability will continue to act as a drag on the market. So I think we got to balance the two, and we are continuing to see sort of FI money coming in. So in the short term, I expect a bounce back to happen in Nifty.
Ajay, what sort of queries are you getting from your retail clientele? I mean, are they shaken up? Whoever's invested in the market, that is, with the recent events of the last 4 days, now we're below the 5,700 mark. Are they willing to now, withdraw and pull out of the market?
Sorry, your voice is, there's some break in the voice. Could you repeat the question, please?
I was talking about what sort of what sort of comments are you getting from your retail clientele? Are they willing to withdraw money from the market, whoever's invested in, or are they now, queries coming in to actually, put in money into the markets right now?
Yeah, I think the unfortunate part that one has seen in the rally over the last 12 to 15 months has been singular participation in large numbers by the retail investors. I think the rally has completely been fueled by $25 billion of FII flows in calendar year 12, followed by around $9.8 billion in the year to date in the current calendar year. Whereas we have seen both the domestic institutions being net sellers in calendar year 12, as also in the first 3 months, and also the retail investors watching from the sidelines. But I think this is in the short term, I think there are a lot of large cap stocks which have come up very sharply, and where we see in the short to medium term a good scope for appreciation. So I think from the timing perspective in the short term, I think one should continue to look at some of the large cap stocks in the portfolio.
So far this year, we freely used the word bull market, but now do you think we should now start focusing on the bear market? Because if I keep 8-10 stocks aside, pretty much 80% of the market is in some kind of a bear market.
Well, I think in addition to the concerns, I think on macroeconomy, that politically, I think we are entering a treacherous terrain, and that sort of could act as an overhang on markets sort of moving up very sharply. But as I said, I think in the previous part of the interview, that as long as the global risk-on trade continues and money keeps on pouring in India, I think you just can't fight sort of liquidity. So from that perspective, I think one should not be extremely negative on the market. And as I said, in the short term, we are expecting a bounce back, and one can sort of look at a mix of some defensives and a bit of interest sensitives also, because although the RBI has been extremely cautious and said that the further monetary accommodation looks quite limited, we still feel that around a 25 basis point rate cut, maybe over the next a couple of quarters, is more likely than not. And to that extent, I think in addition to defenses like ITC or NHPC, NTPC, we also are looking at some of the cyclicals in the banking sector, like private sector banks like ICICI Bank and Axis Bank, which have come off very sharply over the last few weeks. We are also looking at some of the IT names like Wipro and Infosys in the large caps, and Petronet LNG in the oil and gas mid-cap space as scripts where one could look at taking positions in the short term.
Lots of stocks, Ajay, but let's discuss the private banking space. And if I compare the 5-day change here of HDFC Bank, Axis Bank and ICICI Bank, ICICI Bank has fallen the most. In fact, the stock is down a good solid 300 rupees from the recent high. So any specific reason why ICICI Bank is underperforming the private banking space?
I think, among the three banks that you mentioned, ICICI always, is the highest beta. And hence, I think, it does tend to move sharply as compared to HDFC Bank and Axis. And HDFC in particular has sort of, been a bank which has been having the lowest beta. So I think, when the Cobra Post sting did strike the media, I think the reaction was, in my opinion, disproportionate in case of banks having higher beta among the three banks that you mentioned. And hence, I think, we saw a sharper erosion in ICICI Bank vis-a-vis the other banks. Be that as it may, I think we still believe that from the fundamental perspective, a falling interest rate environment, the fact that I think, these private sector banks do not face the NPA issues anywhere close to what some of the larger public sector banks and smaller public sector banks face, makes us positive on taking positions in ICICI Bank and Axis Bank.
Ajay, good having you on the show. Appreciate you taking the time out as always.